Good day, and thank you for joining us for the BCI Korner Perspective Flexible Fund Report. And we're really covering two periods here. The first is and that's the bulk of the report, to the 30th of June 2023. And that's really just so that we can synchronize it with the other four videos in the series. But then we've also done the 31st of July review, and really that's because that gives us the 5-year history, and it obviously brings it a little more up to date. We also just mentioned that this video really is the last in a 5-part series. We would urge you to watch the other videos on our YouTube channel that cover the big picture, the asset market reviews, particularly if you want to get a deeper understanding of the motivation for the underlying equity positions in the fund. All right, so very quickly, just an introduction. It's a flexible mandate, which means we can and we are quite flexible in the asset allocation and the asset selection. We very firmly don't believe you should sort of track around the benchmark, and you'll see in a second the extent to which we often do run quite significantly different weightings to our benchmark, which technically is 70% JSE capped SWIX, 15% in the listed property index, and 15% then in STEFI, which is really just cash. So that's it's called it the technical benchmark. What we really want to do, though, is we want to generate attractive, sustainable long-term investment returns that beat inflation. But importantly, we want to try and manage the downside. So, everybody seems to focus more on return, and yes, that's important. But we also feel that active management of the downside through asset selection is also very important. It's important to say that this fund is very much a South African focused fund, and really because most of our investors, most of our clients have offshore portfolios, and we will then give them exposure to segregated mandates, generally offshore. A lot often said about investment style. If you had to put a label on it, we're generally more value oriented, I think, as you will see, particularly out of our local portfolio review video. And then I think it's very important to say we only add assets if we really feel they are likely to make a positive contribution to returns. We don't just add assets because they're popular or they sit in the benchmark or because we don't want to be too far away from any sort of metric. All right, the fund review to the 30th of June, as I say, we're really just going to touch on the asset allocation and a couple of the bigger positions, but we're really not going to go into any degree of detail on the underlying holdings. All right, as at 30th of June, the asset allocation was 77% sitting in equity. Cash and money market is right down now to 14%. We're sitting with bonds of around 6% and pref shares as at the 30th of June of 2%. With basically no money invested in property, borrowing, and minimal allocations through an income fund that we hold. All right, as we say, we really aren't afraid of asset mixes that look quite different to the benchmark. And what we're trying to illustrate here is over a period of time, starting with the 31st of December 2018, when the fund was really only 6 months old. As you can see, cash was about 64%, equity was only 22%. So obviously massive benchmark risk at that time. And that, I think, was really just in reaction to a very difficult environment. As you can see, in 2019, middle of 2019, when the fund was about a year old, still almost 50% in cash. And quite a lot in bonds, and still nothing virtually in property. Moving on to the bottom left, which is the 30th of June 2020, we're sort of in that COVID chaos. Equity was then up to 62%, cash down to 25%, and domestic bonds, which were really taken as because of the yields being pushed higher, courtesy of the COVID sell-off. And then you can see 31st of June 2021, which is obviously still 2 years ago, but then we were up to almost 66% in equity with only 20-odd% in cash. So we're really not afraid to mix the assets up as we feel necessary given the market conditions. All right, just a very quick look at the non-equity bucket. As at the 30th of June, you can see cash and money market represent about 72%. Pref shares then 9% of that bucket, similar numbers in inflation-linked bonds and sort of more traditional vanilla bonds. Then if you look at the high-level commentary on the equity bucket, very big exposure to the financial sector, and also quite a big allocation to net asset value plays, with examples being Naspers, Ethos, Mutual, Remgro increasingly, and ARC, and also quite a significant allocation to private equity. And in part because we see a lot of investment merit there, but I think also a logical response to an ever-shrinking JSE. But importantly, you know, net asset value, you have to be comfortable with the underlying. It doesn't help you buy, you know, a lousy portfolio at a big discount. And then you'll see, you know, one or two examples of this where the PE plays are sitting on what we believe to be very attractive multiples relative to the earnings growth prospects. And then finally, you know, we're very, very differently positioned to the equity benchmark. Okay, the equity bucket, effectively, we've got the biggest positions in Standard Bank and ABSA. Obviously, the rally in the banking shares has seen them, you know, become the biggest position, followed by Aspen, and then TFG, Virginie Group, quite significant at 5%. It's a relatively new position, and then Naspers and Old Mutual coming in, you know, around 6%, 5%. As you can see, fairly equally weighted positions, you know, from TFG all the way through to sort of CUP and 91, around 4, 5, 6%. So it's not a very deliberate strategy, but we do feel that you know, when you have conviction in a counter, even if it is a relatively small cap like an Ethos, we're not afraid to expose our clients to those. And then, as you can see, you know, there's a fairly big tail, you know, 1% and 2% positions. Some of those are quite new, as we'll discuss later, like Amplats, and others we've obviously been down weighting. All right, then, as you might have noticed, there's quite a lot of concentration. So those big 5 positions, the top 5 positions, represent about 36% of the equity bucket. And the top 10 positions, as at the 30th of June, represented about 62.5% of the portfolio, with you know, the smaller holdings representing obviously the balancing 38%. It's important to say that some of those positions, things like Bell and York, while we're very comfortable with the underlying value and the stories, of course, the lack of free float in companies like York and Bell really mean that it's prudent to not expose yourself to too much in case you do need to create liquidity. All right, I think a couple of slides, if we may, just on talking about how cheap we see the South African market. We'll end later with, you know, the performance figures. But South African equities, particularly locally oriented equities, are looking historically very cheap. What we're illustrating here is the Standard Bank PE over an extended period of time, over a 20-year horizon. The orange or red line there is really illustrating the long run the long run simple average. And as you can see, Standard Bank share trading at a very, very undemanding rating, kind of ratings we last saw, you know, in the GFC, obviously after Nenegate, and then with COVID. So we see very, very good value, and we're comfortable with the longer term prospects of these businesses. All right, you know, we are unafraid to be different from the benchmark, but we don't set out to you know, consciously invest away from the benchmark. As you can see, the top 40, which itself has actually been a very volatile underlying index in terms of constituents. If you think back, you know, how big a position an SAB played, of course, subsequent to that, Naspers was, you know, over 25% of the index. BHP at a period was a massive component, and Richemont as well. And all of those four companies went from being by far and away the biggest component, or very big components, down to very nominal components with the corporate actions, and of course SAB being delisted. So the point we're trying to make is that yes, we're very differently positioned to the let's say the market, the top 40. That the reason for that is, we believe that the underlying constituents that we hold are good businesses, regardless of whether they are heavyweights in the index or not. And as you can see there, yes, we hold Naspers, as you just saw, but it represents circa 6% of the equity bucket, whereas Naspers now, with the de-weighting of BHP and Richemont, now once again the biggest component, followed by Anglos. We'll talk to the lack of commodity exposure in a second, but yeah, if you look at the top sort of 6 shares there, they represent about 50% of the index, with quite heavy concentrations in a handful of those bigger plays. Effectively, we've got a position in Naspers, although quite different from the market, and Standard Bank, and then you have to get all the way down to ABSA, which wouldn't even be in that cohort that makes up the half of the index. So yeah, and as you can see, smaller positions, some 25 shares, only represent 27% of that benchmark. So really not a great benchmark if you're trying to expose yourself to SA assets. Just if we look over a period of time, and it's sort of a little bit vague, but and the activity to the end of June, for example, particularly in the equity bucket, we bought and sold Richemont warrants. We bought Richemont when it got beaten down on some anxieties around the prospects for luxury goods, and particularly after a disappointing period in China. Yeah, we are now out of those. We made quite good money. We bought and sold Sasol. We have the view that it's not a business we want to own long term, but it really looks very cheap. And in fact, in the last couple of days, we got guidance from them where yeah, you're looking at forward multiples of well under 8 times. And then we also bought and sold some additional Naspers holdings. And we've been trimming down over a period of a year or so the likes of Discovery and ShopRite. Really not because we don't like ShopRite, we just think that the price is a little over the top. All right, you'll have seen we've got quite a lot in financials, but we've also been adding what we would call market proxies. So in other words, businesses that benefit from stronger equity markets, and those are Coronation, Old Mutual, and 91. We continue to add small caps, and then we've added quite significantly, as you saw, to TFG and Remgro, which is a business that we feel has got its mojo back after a period of slumber. And then we've also added fairly nominal positions to Amplats and Wilson Bailey. All right, this, as we illustrated in the local portfolio review and the asset market review, this is where we see our everything we do coming together. Effectively, the x-axis is the PE multiple, the y-axis is the earnings growth, kind of over a 2, sometimes 3 financial year period, depending on how close the earnings release is. As you can see, quite a few of the shares we hold are sitting on forward PEs of under 8 times, delivering 10 to 15% earnings growth. It's really that sort of block in green. Yeah, so I mean, left is on the x-axis is good, and higher on the y-axis is good. And we feel, when you're getting 8 PEs from businesses that are likely to give you, compound average earnings growth of, let's say, 8 or 10% over the next 2 or 3 years, maybe with a bit of forecast risk on the upside, we're very comfortable. So, yeah. All right, then. We've got a nominal position in BHP Billiton, a very nominal position in Sasol. And people might ask, well, why don't you hold Anglo American? It's 11% of the index. You saw in that top 40 pie chart, gold shares, platinum shares, and miners generally have become quite a significant component again. And really, this chart says it all. The resources index, the RESI 10, very volatile. And generally, we prefer to invest in sectors and businesses with greater degrees of forecastability. And as you can see, the resources tend to be quite erratic. Ironically, we believe the time to buy resources, and we generally see them as fairly cyclical, is when the multiples are high and the bad news is kind of baked in and the outlook is improving, and not the other way around. All right, property remains a concern. We've spoken in the other videos about the anxieties we've got around the South African property scene. This is just growth point as a proxy, as you can see in that bar chart, the blue chart being earnings per share, the orange one being dividends per share. Earnings and dividends considerably down on where they were a few years ago, although the market is looking for an improvement over the next couple of years. We think that might be a little bit premature on the combination of the debt, which is that block on the top right, as well as the vacancy levels, which we don't think are going to improve massively. And then, we've seen more and more pressure on property companies because of administered prices going up and the inability to negotiate much higher rentals. So we still are not very optimistic on the property scene, although we do concede after a decline of around 50%, there definitely is better merits in it today, but we feel it's still a little bit early and hence no allocation there. All right, we thought we would just maybe unpack one or two of the graphs and tables out of the minimum disclosure document from the 30th of June. As you can see there, the red line in that chart on the top is the Korner Flexible Fund. As you can see, largely tracking the benchmark, which is quite perplexing considering just how differently we are positioned more often than not, whether it be in asset allocation or in the underlying equity bucket. So yeah, we are quite surprised at how closely the fund has tracked the benchmark, but we're starting to see it dislocate, and that's something we've been quite encouraged by. As you can see, on a one-year view, 12% give or take is very similar to the benchmark. Of course, it's important to say that the ASISA category is quite a mixed bag of strategies, quite a lot of income funds and alternatives in there. So that's not a great proxy, but yeah. And then if you look a little further out, obviously, since inception up 30%, and a fair amount of that obviously is in the form of yield, which is something we quite like. Dividend yields of 4-5%, go a long way to generating a portion of your total return. I think the important thing, as we said earlier, is it's not all about return. Return is important, but we've seen a lot of volatility. If you look at those charts and you've watched the fund over time, you would probably have seen that it tends to lag somewhat in strongly trending upward markets, but it also doesn't fall quite as much in downward markets. And this thing talks to that. If you look, for example, at our risk metrics, the fund on a 3-year view has got a standard deviation of a little under 10 and the benchmark at about 12.5. And you can see also on the drawdowns and the peaks and troughs. All right, then very quickly, just having a look at the update to the 31st of July, and we really just wanted to include this, to bring you up to speed with the more recent developments, but also we now have the minimum disclosure document for July, so we now finally have a 5-year history. All right, so I think we've seen fairly significant inflows into the fund over the last few months. We've also been trimming a few of the holdings, things like Sasol and Naspers and Discovery and ShopRite, and that's had the effect of increasing the cash a little bit, although we have, as you saw, if you look over a year view, we have increased the equity, and we've added some bond trackers, and we still feel that big bank prefs offer pretty good returns, but the short end of the curve, obviously courtesy of what the SARB has been up to, you've seen yields move quite nicely up on cash. All right, then very quickly, the asset allocation. As we said, the equity bucket is down slightly at about 73% from 77 in June. and really cash has received the bulk of that as we've liquidated a couple of those positions like we just mentioned, and just a modest additional allocation to prefs. But as we say, there has been a fair amount of inflow into the fund, and it's been somewhat difficult to deploy that into a couple of the existing positions. Then just looking at the equity bucket, very similar to what we had at the end of June. Standard Bank, ABSA, Aspen, TFG, Naspers, all the big five in our portfolios, followed by Mutual, ARC, Remgro, Ethos, and City Lodge. So a very similar story to what we had, as you can see. Shoprite and Discovery down to 1%. The plan is basically to exit Discovery in total within the next few months. And we have been fortunate in being able to get good prices over the last year or so. Still very concentrated. The top 10 now represents 65% of the equity bucket. That was 62 a little while ago. So even though we're not betting on index heavyweights, we have high conviction, and we're very happy, as you would probably have seen in the local portfolio commentary or video. We're very comfortable with the underlying fundamentals of these holdings. Then very quickly, just looking at the minimum disclosure document, as I said, we now finally have a 5-year history. And as you can see, I think quite interestingly, the fund was lagging its benchmark slightly. And you can see the month of July was actually quite good for the fund, where we are now ahead of the benchmark on the 1 year and the 5 year. Yeah, so we're quite pleased by that, and I think, as we're going to say in a little while, we believe that the fund is very well placed. So it's gratifying to see it, even with a sort of quite contrarian positioning, to be delivering similar returns. But importantly, we're delivering those returns with less volatility than the market or than the benchmark. As you can see, over all those periods, standard deviation is lower than the fund benchmark. And if you look over, a 3-year history there, for example, you're still seeing, maximum drawdown of 7.3% versus the fund of 10.8%. And on the standard deviation, full 2.5 percentage points difference in standard deviation. So the returns have been improving in spite of the fact that the risk is on the way down. Then finally, just I think what we're saying is, the fund has done better, but we are very comfortable that it's very well positioned. Valuations are very undemanding. Great discounts to NAV give you the possibility, with underlying assets that we think are better than a lot of what is listed, gives you sort of a double dip opportunity. We are very well placed for South Africa doing better than a lot of sort of the doomsday prophets might suggest, although I don't think we need that, because if you look at the big banks, the earnings growth is going to be there, not great, because I think the more recent rate hikes are starting to bite a bit, but the bottom line is there'll be decent earnings growth, and these multiples are very, very affordable. And I think we're also very well placed to see a recovery in small and mid caps, which have really been under the whip because of the drainage of liquidity, as we discussed in some of the other videos. So we thank you very much for listening to this. We trust it was insightful. As always, our clients, investors are welcome to reach out to us if there's anything in specific that you feel we didn't address, or if you have any specific questions or comments. Thank you for your time, and we'll see you soon.